We'll now return to the 4 principles of Islamic finance that we began covering in the previous podcast. And now we will look at principle number 4. Don't charge interest. Why shouldn't you charge interest? The reasoning that is given to us by Islamic jurists is, first, that in an interest-based transactions, risks are not fairly allocated. The lender typically bears no risk or very little risk, but the borrower bears all of the risks. So let's say a borrower gets money from a lender. The lender has a guarantee of getting his money back with interest. The borrower, on the other hand, invests the money, and who knows if that investment is paying off or not. Now you might say, doesn't the lender bear the risk of borrower default? And that argument would be made by Western economists or financial experts. Muslim jurists reply then that in Islam you really should only enter an agreement that you expect to be fulfilled. You should do your due diligence, making sure that the person or the entity to whom you're lending knows what they're doing and will be able to pay back, minimizing the risk of default. If you're a depositor at a Western bank, you can just give your money to the bank and the bank somehow gives you interest for it. You do not have any burden of doing your due diligence. In Islamic finance, a person that has money and gives that money to a potential investor, getting perhaps a profit in return, has the obligation of doing their due diligence. That's a quite substantial difference between the two financial systems. What is then not allowed that we do in the West? Well, in the West, for a long time, mortgage brokers would sell mortgages to subprime lenders that did not have the ability to actually repay their mortgages. And then they sold balloon rates and other things. And that contributed to the financial crisis, 2007, 2008. Muhammad Ayub, the author of one of the books that I showed you before, adds that a borrower remains accountable for a loan in the hereafter. Which means that if you are a believing Muslim, and you believe that you remain accountable for a loan after your death, you have an extra incentive to actually pay back your loans. There is a second reason why you shouldn't charge interest, and that is stated by Mr. Rahman as follows. He says, the Sharia views money as a store of value and a medium of exchange, not as a commodity. Therefore, money should not be exchanged at a price. Rather, it should be a means for the exchange of goods and services. In other words, money is simply a tool. It is not something that you can buy or sell in its own right. It is not a commodity. Hence, whenever you simply give money for just in and of itself, you must give and take at face value. But whenever you sell an asset, something real, something underlying, you may charge whatever price you choose. You may even charge a higher price to a customer that says, well, I want that product now, but I can't pay you right away. You in the West might say, hey, that's interest. But it really isn't, because the view of money is a fundamentally different one. We, in Islam, they view money as a tool, not something that can have a price of its own. That has some consequences. One of them is that discounting debt is not permissible. Munawar Iqbal, the author of the article Islamic Finance, An Attractive New Way of Financial Intermediation, wrote, The prohibition of discounting debt is a logical consequence of the prohibition of interest, or in Arabic, riba. A debt receivable in monetary terms corresponds to money. Debt is money. And in every transaction where money is exchanged for the same type of money, the exchange must be at par value. Any increase or decrease from one side is tantamount to riba, or interest. So you cannot discount debt. What does that mean? Let's say you went to a hospital and the hospital does not get from the insurance company the amount of money that thinks it should get. In our system here in the United States, it can happen that the hospital simply sells what they think you owe them to a debt collecting agency. And what they do is they tell the debt collecting agency, this person owes us $3,000, but if you handle collecting the debt, we will sell you the debt for $2,500. And if you get the money or if you don't get the money, that's up to you. The hospital has sold discounted debt to a debt collecting agency. It has exchanged $3,000 for $2,500. And Mr. Iqbal says that is not permissible. You're exchanging money for money. You're not exchanging money for an underlying asset. The other consequence is that collateralized debt obligations, with which we already had a problem because of opacity and uncertainty, are not permissible. Because collateralized debt obligations are debt that are then bundled and resold, and you're really not trading an underlying asset. You may think, hey, these people in Islam, they're just weird because everybody charges interest. Let's remember that Christianity and Judaism don't like interest either. And Rahman explains to us that interest in Christianity was prohibited for the longest time until the church made a difference between interest, which is not such a high rate of return on lending out money, from usury, which is a super high interest rate. But that was a novelty, that was an innovation. For the longest time, Christianity rejected the charging of interest. And the same is true for Judaism. Judaism has difficulty with the concept of interest. So the three monotheistic religions have quite a bit in common here. You will say there's so many things that are not allowed. The short sale of stock is not allowed. Western type insurance, interest generating investment, selling discounted debt. Opaque derivatives such as collateralized debt obligations are not allowed. And it's also not permitted to do business with people who will, in your estimation, very likely fail. Meaning that the Islamic financial system must look very different from the one that we have, and it's not only due to a different understanding of interest. What's the alternative then? And there are two basic tools that form an alternative. One of them is the deferred sale tool. A merchant may charge a higher price in the case of a sale with deferred payment than she would if the buyer were paying cash today. Let's say you want to sell a washing machine and the potential buyer says, I really would like to buy that washing machine, but I can only pay you a year from today. In that case, you as the buyer may charge a markup because the underlying asset is a real asset. There's something real that is being traded. But what is not permissible is to charge a price other than face value if the thing that is being changing hands is not a washing machine, but it's money. So deferred sale is a tool. And the other one is equity participation in an investment project where profits and losses are shared.